Hey, it's Frank Nagy, and welcome to my channel where we help financial entrepreneurs grow their business in the financial market. In this video, we're going to meet Zach Ziliak, founder and managing partner of Ziliak Law Group out of Chicago, who's going to explain the top 3 U.S. exemptions for startup hedge fund advisors. Let's get started.
Hey folks, this is Frank Nagy, and I have Zach Ziliak from Ziliak Law Group, and been doing business with him for a number of years now. And I think that he's an expert in the Securities and Exchange Commission's laws and regulations that really govern not only the hedge funds, but the fund advisors that we really need to address. So without further ado, Zach, take it away. Let's talk about the top exemptions that fund advisors are going to need to address when they start a hedge fund.
Well, let's see. So first of all, thank you very much for having me. And when you talk about a hedge fund, a lot of this comes down, first of all, to what they invest in. So you talk about the Securities and Exchange Commission. If your fund is investing in spot crypto, you don't have to worry about the SEC. If you're investing in commodity futures and other derivatives, you might have to think about CFTC issues. But again, the SEC, not so much. But let's suppose you're investing in securities. Now, indeed, the SEC is going to take an interest in you if you are, for compensation, as a matter of business, providing advice on securities, which can mean managing funds or advising people on their own holdings or whatever else. I like to break these kinds of funds or these managers down into, let's say, small, mid-size, and large ones. And the exemptions you're talking about allow people to sort of move down a shift, because there are small ones where, let's suppose, where a fund is basically managing under 25 million US. And there, the SEC says, don't bother with us. You know what? We have bigger fish to fry. Please don't register, don't file things. Your state might want you to do things. That's great. But the SEC level, not so much. Then there's this middle tier from 25 million up to 100, 110, 150. We can talk about where that top tier, that top cutoff is. But this middle tier, where generally speaking, and I'll get to some exceptions, generally speaking, the SEC says you don't have to register as an investment advisor, but we still want to know some things about you. We want to know that you have some anti-fraud provisions, anti-money laundering. We want to see you file something with us, report on an annual basis, file part 1 of Form ADV. So give us some basic idea of what's going on. So these are commonly exempt reporting advisors, exempt from registration as investment advisors, but still filing some other report as advisors, this middle tier. Mm-hmm. Now, as you mentioned, there are exemptions for this. So one of them has to do with private funds. I talked about, is the middle to large size at 100 or 150 or wherever else? This comes down to, if you are just managing funds, okay, or a plain old hedge fund, but not separately managed accounts. If you are just managing funds, then they say that cutoff is 150. Now, and it doesn't matter how many funds you're managing. You manage 50 funds, still the cutoff is 150. Any one separately managed account, so a bespoke investment product for one favored investor. Now you're no longer just a private fund manager, and now they say, let's take this cutoff down to 100. Okay, so this private fund exemption says if I'm only managing funds, then that 100 to 150 tier, we'll call that mid-size rather than large. So instead of having to register as an investment advisor, you just need to be an exempt reporting advisor. That simplifies things for you.
Now, exempt reporting advisor is interesting because I think that brings some comfort to some investors that, unlike a startup fund where they've got 4 or 5 million, maybe up to 20 million, depending on the state laws, as you just mentioned, a lot of the larger investors will say, listen, I know you're not really required to be a full-fledged registered advisor, but let's see some accountability. So, when you're reaching that 20, 25 million plateau, makes good sense, and even the law, to register as a exempt reporting advisor, not just for regulatory purposes, but even just for credibility. What goes into an exempt reporting advisor? What are some of the requirements that they would have to file each year?
So first of all, I think you're exactly right, that above and beyond the legal requirements, there is a marketing benefit to this. And as you mentioned, smaller fund managers might still need to register with a state or multiple states. And that carries some credibility, but there's additional credibility that comes from the SEC side. And in some rare circumstances, funds, that is, managers under 25 million under management, if they're just in lots of states in some ways, can still fall under SEC registration. But generally speaking, under 25 is like no. But now this 25 to 100 or 25 to 150 range, when you have the exempt reporting advisor kind of piece. But if you are just an exempt reporting advisor, you have to file part of it. So part 1 of this, you still have to file on an annual basis. Also, there are certain just requirements. You still act as a fiduciary. The SEC, still wants you to have anti-fraud provisions in place, anti-money laundering provisions in place. Also, just a matter of best practices, you should have code of ethics and whatever else. You will also be subject to examination by someone or other. Now, what I mean by that is most states will say, if you are registered here at the state level and such, we run audits, essentially, investigations on a certain percentage of you registered advisors every year, and just take turns, okay? Just to make sure you're following the rules. If you are in a state, famously Wyoming is like this, that does not examine its registrars, its registrants, then the SEC, if you're at that middle tier, says, all right, I guess register here then, because you better be on somebody's list for examination. Another exemption has to do with venture capital funds. If you are a manager that just does venture capital, then even if you're larger than 150, larger than whatever size, you're sort of treated as that middle tier where, again, you become exempt reporting advisor. You don't have to register as an investment advisor, but you still have to file Part 1 of Form ADV on an annual basis and have these anti-money laundering, anti-fraud provisions and all the rest.
What is the cap on the AUM on that? If 150 is the cap, so to speak, with your smaller mid-sized advisors, with venture capital, is there a certain limit that the SEC imposes on the AUM?
Qualification for venture capital is not based on AUM, though. Once you get large enough funds in general, large enough private funds have to file Form PF and so other things beyond this. I'm talking right now about just registration or not, any kind of filing or not. But there are additional filings that come up in larger funds. But venture capital qualifications as a venture capital manager is not based so much on AUM as rather have to have at least 80% of your investments in some qualified investments. Getting into exactly what those would be is a little complicated, but roughly speaking, we're talking like significant holdings in risky new issuance. These are more like private equity funds or something where you as an investor put your money in and it stays there until the manager is good and ready to get out. They collect money from investors. They invested in certain things, anticipating those companies will grow, and then they have a planned exit X years in the future. And then when they exit, they give you, the investors, the proceeds of this and such. So one of the requirements for being a venture capital manager, and hence being able to avoid full registration just to the exempt reporting advisor tier, is to say we have limits, strict limits on how people can get out aside from emergency situations. Also, there are restrictions on leverage, and again, the kinds of holdings you can have.
That's interesting, because a lot of our clients that you and I have done business with, we never had the prevalent pleasure of setting up those type of funds. Now let's talk about really the state level. Now you mentioned about the state laws. The hedge fund is set up. It's a mid-sized fund, maybe 10, 12, 15 million. And now the fund manager advisor says, hey, I want to get somebody out of New York, Pennsylvania. Don't they have certain filing requirements called blue sky laws?
Great. So thank you. Yes, I want to amplify what you said just a moment ago, that yes, it is definitely advisable that your hedge fund clients and such, your fund manager clients, speak with you about this sort of issue and speak with me or their other attorney about this, because we're just going through some rough guidelines today, but this is not legal advice. These are not final answers.
That's correct.
These are rough summaries of how this might work. Now, as for the state side thing, you're absolutely right. There are state level requirements in multiple areas. First of all, for an investment advisor, that you might need to register there, or there's some restrictions on how you can charge your clients or whatever else. You mentioned blue sky filings. So this brings us to another separate piece, which is, we've talked a little bit about the Investment Advisors Act, and there's a separate thing about the Investment Company Act we could talk about, basically mutual funds and such, and the registrations that come with that. That's another separate topic. When you say, I'm running a pooled fund here, okay, instead of separately managed accounts, I'm going to invite you to put your money into this pool, and I will run the pool a certain way, and you get your pro rata share of that. The interests in that pool that you sell are securities. When you sell securities, just like a regular company does, whether you do a full-on IPO and register it with the SEC, that's definitely doable, but it's a significant undertaking. But there are various exemptions from that. You mentioned blue sky filings. So if you are a small manager just managing money from one state, still the various states want to know that you are selling these securities, these interests in your fund in their states. So you have to do a blue sky notice filing there, just telling them, hey, we're doing this. Typically, there's a filing fee for this in most states.
That's great because a lot of clients that come to me fail to recognize that they think that once the fund is set up, once you review the documents and signed off, and they're ready to go, they're off to the races. And that's the easy job. They are going after raising money. Later on down the line, when they start raising capital from, like I said, New Jersey, New York, Pennsylvania, wherever. So I think it's best that when the fund is launched, they have to be equipped to file those things when investor. Now, by the way, they don't have to file multiple filings with the state. It's really one filing if they have whether one investor or 100 investors from that state. Is that right?
So this is right. When it comes to issuing interests in your fund, whether there's one investor there or 50 investors there, once you file once, you're set. Once you've made that filing and made that filing fee, whether you're selling to one person or 50 people there, you're still okay. But then you run into the good problem to have, that is, if you find yourself having investors in more and more states, each time a new state comes on board, there's additional filing there. So there's a minimal filing in terms of the complexity of it, but there is a filing required, and there's typically a filing fee.
How many years have you been practicing law now, Zach?
Let's see. That's sort of an interesting question because this is a second act for me. I started out, I was a quant and then at an investment bank and later head trader at a prop shop. Yeah. And so I worked designing and implementing automated trading strategies and working with US equity options and FX exotics and various things like this. So I came very much to the finance direction for, 3 change directions going to law school. So I've been an attorney in this area since 2006.
Zach, I appreciate your time. I'm sure that a lot of viewers are going to reach out to you that already have an established hedge fund and may need me to really say, hey, you know what? Zach touched on some things that we better look at our files and think we might be missing something. So to do that. Well, Zach, thanks a lot, and we'll talk soon. And I hope everyone has a great day today.
Hey, I hope you enjoyed this segment of Law Talk. My friend and attorney, Zach Ziliak from Ziliak Law out of Chicago. If you're looking to start a hedge fund, I recommend my hedge fund book, The Ultimate Hedge Fund Guide. Click on that description box below where you can find out where to purchase it.